Managing Director and Group Head of Research for CGS-CIMB and the Head of ESG Investment Research. He has held various roles in the organization, including Head of Institutional Client Account Management, Head of Equities, Hong Kong, China, Head of Research, Hong Kong, China, Head of Telecom Research, Greater China and Hong Kong, China strategist. So he knows data. In 2019, he collaborated in the inaugural ESG report for the firm and has since led the integration of ESG throughout the research product. So this is a person that understands the importance of metrics. ESG, this is like my personal, subject I'm super excited about. And we are fortunate he could travel here to be with us today. So I'm pleased to introduce Bertram.
Wow, thank you so much, Van. So good morning, everyone. I really did enjoy the sharing and perspectives about ESG over the first day of the conference. So I do remember what happened. And it's heartening to see how entrenched ESG thinking is in the Vietnam investment mindset. So firstly, a big thanks to Mimi and Van from Raise Partners, Hao from Vietcetera for putting together such an important event, and also to sponsors Dynam Capital. So Consul General, honored guests, firstly an introduction to who I am, what my firm does, as the name may not be that recognizable here in Vietnam. What we do that may be relevant to measurement of value and impact in ESG. Okay. So firstly about the firm. So I manage research for CGS-CIMB Securities. We're a capital markets firm, majority owned by China Galaxy Securities, the second largest broker in China. We're listed on the Hong Kong and Shanghai exchanges. We have over 14 million customers. Of course, 13 million of those are in China. We're a central SOE owned by the Chinese government. As with most financial firms, we are the result of several mergers throughout the years, but we trace our origins back to Singapore GK Go firm and ABN AMRO, both franchises which started in the 90s. CGS-CIMB is the offshore business of China Galaxy. We're headquartered in Singapore. We are in 6 markets in Asia with 2 offices outside of Asia in New York and London. Our client base consists mostly of international institutional investors, increasingly though, ASEAN domestic institutions that are investing offshore, hedge funds, and about 400,000 retail clients, primarily in Malaysia, Indonesia, Singapore, and Thailand. We provide advice on over 650 listed companies in our core markets, and with our parent and research partners cover a further 3,000 listed companies in China, the US, UK, Europe, Australia, the Philippines, and Taiwan. But we are not yet here in Vietnam. So the ESG investment lens, as mentioned by Craig yesterday, is something our institutional clients look through. But we're constantly faced with the question from public market investors of how does this actually help? Especially when we talk to retail investors. So ASEAN markets used to be dominated by institutional investors about a decade ago. But today, that has now become a 50-50 market that's shared with retail investors. So retail and institutional investors want to invest through the ESG lens. As Craig mentioned again yesterday, a figure of over 80% have stated that. But the constant question we are asked is, how much return do we have to give up in order to invest sustainably? So what does a capital markets firm know about ESG? I'd like to add the perspective of a public market investor. So we began our journey 5 years ago when we hired our first ESG analyst and published an analysis of ESG performance in ASEAN. We concluded that investing in highly rated ESG companies led to zero outperformance, as good ESG performance, which is defined by high ESG scores, are already fully valued in the share price. However, we also found that stocks that were outside of the main ESG indices and moved into an ESG index outperformed the market by 14 percentage points. Hence, our first important conclusion was that ESG is effective only as a forward-looking investment factor for outperformance. Investors should indeed be looking for firms with low ESG scores, but with an ESG game plan to lift those scores. So for investors, being forward-looking is not something new. However, what is surprising is that ESG scores have been used by capital markets up to now in a very backward-looking way. I think this is part of the reason why we're now facing somewhat of an ESG backlash and why we need to move beyond the ESG score. So I think there are three main issues with the way ESG scoring has been used to date. Firstly, ESG as an exclusion factor. So capital markets can and should encourage firms to make holistic long-term decisions to ensure the sustainability of the firm and its business model. So the UN defines sustainability as meeting the needs of the present without compromising the ability of future generations to meet their own needs. So in ESG 1.0, investors excluded certain sectors that did not fit the sustainable investing notion, such as oil and gas, palm oil, tobacco, gambling, or weapons. In the oil and gas industry, analysts at our partner firm, Bertram, in fact, conclude that sticking to your knitting, i.e. keep pumping oil, has actually been the most rewarded strategy by capital markets for oil and gas firms. So, Mimi, I know you won't like this, but it is the US firms without strong ESG mandates that have outperformed their greener European peers. So we think that outperformance of ESG laggards in the oil and gas industry has probably been a result of ESG agnostic capital. So capital market investors not engaging with the companies. So through exclusion, capital market investors do little to influence firm behavior. Instead, we think ESG investors should be investing in ESG leaders across all sectors to provide capital to sustainable business models and take capital away from firms with unsustainable businesses. Secondly, ESG scores have been used to create investment products. So ESG ratings are an inherently backward-looking measure which looks at reported performance, which is often 9 months out of date, against a range of factors, typically about 300 of them. So the fact that investment products have been created and launched to market that use ESG ratings to passively select portfolio stocks is an inherently losing game, as we've already discussed. Where ESG ratings do come in useful is in providing a quickly understandable score of the business's past performance as a basis for further analysis of the management's future ESG performance. Of course, there is a correlation between disclosure and ESG performance. This is circular, but positive. But the true driver of impact is whether management have a forward-looking plan for improving ESG performance in the future and an investor's assessment of how credible those plans are. And this is something that a score does not provide. Okay, this is a big head there. So thirdly, ESG is being muddled with sustainability. So some of you will hopefully know this gentleman who caused some controversy a year ago with his comments about ESG. The final area where I think that there is misunderstanding is the difference between ESG and sustainability. ESG is an investment framework and a way of reporting and organizing non-financial data so it can be used in an investment decision. Sustainability, I think, is the effort made by management to ensure the continued survival of the company and its business. So while there is a large overlap between the two, they are not the same. Sustainability consists of the firm's strategy, measurement, and reporting. In Dynam's words, the do more, measure more, and report more. ESG is the way that investors look at the measurable outcomes of these efforts. Why is this important, an important distinction? Because the firm may and should do more on its sustainability than will directly impact the investment decision. for example, in its CSR efforts or philanthropy. Investors would be right to overlook these efforts, perhaps, and instead look at the ESG data relevant to the business model and how the company is doing relative to peers and to historical trends. Because it's this relative performance that will drive relative valuation and therefore investment decision-making. So not being clear about these three areas has hurt public perception of ESG. And if investors and marketing departments are not clear on these, measuring the value and impact from ESG, or what ESG is for, is going to continue to be debated. So I'd like to move now to how ESG scores are actually being used. So there's a recently released survey by Professor Franck Bancel and his colleagues, which involved about 303 mostly French portfolio managers, financial analysts, ESG specialists, and valuation experts. So the first finding is that the number one complaint about ESG data is the lack of standardization. So in the survey, 86% of the respondents said that data is not sufficiently standardized. And as a result, what is happening now is that 2 out of 3 investors use an internally developed ESG scoring system to value companies. Also of note is that 1 in 3 investors use 2 ESG data providers. And this is actually a marked decline from past surveys where investors use 3 or 4 data providers. So there is a consolidation occurring in the market. When it comes to the relevance of ESG data on fundamentals, there's a broad consensus that better ESG performance does lead to a lower cost of debt, and there's plenty of empirical evidence that supports this. A lower cost of equity, where the empirical evidence is mixed, but there is some weak evidence that better ESG performance reduces the cost of equity. It leads to a lower level of risk, which is typically the number one reason why investors include ESG analysis in their investment process. Investors also think that ESG performance increases long-term growth and higher sales. However, there's little evidence for this, and this is possibly wishful thinking over the long term. However, there is widespread agreement from most investors that better ESG performance does actually not lead to higher margins or higher return on capital employed. The survey also asked investors how ESG analysis influences valuation models, and here the most common approach is actually not to adjust cash flows, although 40% of investors do that. But they do adjust the discount rate of future cash flows and the long-term growth rate. So essentially, ESG analysis provides a risk and opportunity assessment for a company, and the risks are reflected in higher risk premiums in the discount rate, while opportunities are reflected as higher long-term growth rates. So since 2021, we at CGS-CIMB integrated ESG into our fundamental equity research, meaning that every analyst and every salesperson has been trained on ESG, and our fundamental investment analysis includes developing a forward-looking view on the ESG performance of the company. So we're actively looking for companies that are not yet recognized for being sustainable, but that our analysts have determined that management attention and firm investment will credibly lead to improvement in ESG performance. So in summary, investors should be much more focused on using ESG disclosure to form an opinion on forward-looking ESG performance. And evidence from the Bancel study argues that this is the case. I think all investors hope that capital markets can then drive corporates to innovate their business towards more sustainable models. So just as a final thought, I wanted to show this slide. So this is a map actually provided by the Earth Observatory of Singapore, and it shows the impact of various natural and man-made disasters, including sea level rise. So the EOS has done some important work, and as part of that, they've identified that 70% of populations affected by climate change and sea level rise are actually going to be here in our part of the world. So while we're all expecting sea levels will rise an average of 1 million globally, this is actually not going to be even. In fact, sea level rise in the South China Sea will be much higher, and therefore ASEAN is going to bear the brunt of the impact. These data models that the Earth Observatory are building, we think can actually provide real risk data. So pointing at specific assets that are owned by companies, for example, buildings or factories that are used by companies to generate revenues. So this data can be used by investors to assess risk and encourage companies and governments to mitigate and adapt to challenges posed by climate risk. So in other words, ESG is soon going to become a lot more precise and allow capital markets to drive better sustainable business decisions. Thank you.